Hi, I'm Mike Maloney, author of Rich Dad's Guide to Investing in Gold and Silver. And actually, most of it is not a guide to investing in gold and silver. There's some monetary history, some of the economics that are behind what is happening right now, so the current state of the global economy. And then there's some potential future outcomes. And my favored scenario in here appears to be playing out. I said in the book there would be the threat of deflation, to which Bernanke would overreact and do bailouts and such, expand the currency supply, and cause inflation to start happening. And we've seen that inflation happen mostly in the stock markets. I mean, he bailed out the banking sector, and what happened? The banks, I said in a video last November, in November of 2008, I said, you watch, the stock markets will bounce and it'll be led by the banking sector. And that's exactly what happened. I said in my book that he would respond to this threat of deflation by inflating the currency supply, doing bailouts and such, and then there would be a real deflation that comes on where the currency supply starts to collapse. So monetary deflation, not asset price deflation, but true monetary deflation. And it looks like that is upon us. Right now, M3 has started to contract, and the Federal Reserve is fighting it with huge amounts of inflation of base money. But base money has gone from about 7% of the currency supply to about 15%. The other 85%, you and I borrow into existence when we buy a home and we sign that mortgage document, or we buy a car and we sign that loan. Through fractional reserve banking, we create the currency. Every time you sign a credit card receipt, you're expanding the currency supply of the planet. But those loans, there's a payment due every single month. And so if the public gets scared and they save and pay down debt faster than they're borrowing new currency into existence, the currency supply starts to collapse, that other 85%. So here's a chart of the M3 money supply. The red on the bottom is base money. The blue area is base M3, which includes base money. Now we're going to deduct base money from M3, and what's left is just the portion of the currency supply that the public creates in the banking sector through fractional reserve banking. And what you see is there's already been $1 trillion collapse of the currency supply. This is huge. It's dropped from 13 trillion down to 12 trillion. That's a good percentage, and it's the biggest contraction. There's never been a contraction like this since the Great Depression. There's been areas where it has gone flat before and not grown. But this is the first time that there's been a really big contraction of M3. So my favorite scenario in the book was this deflationary dip, followed then by an overreaction by Bernanke, and he'll print us into a hyperinflation. I expect this deflation that it looks like we're going into, and this may not be it yet. They may slap some Band-Aids on this thing and blow the balloon a little bit bigger, but all bubbles pop. We are in a credit bubble right now. They're going to create more currency, and the other side of that is credit. It's all debt-based currency, credit debt. So as they create more currency, we're just blowing the credit bubble even bigger. And derivatives are going to get bigger too, because all the banks are panicking right now because of what's going on in the stock market. And that is all credit-based too. So this credit bubble, all bubbles pop, period. As this pops, you should see a big deflation set in. I don't expect it to be a long-term deflation. I expect it to be 18 months to 3 years, possibly. And then Bernanke will print and print and print until the deflation finally gives way. But at that point, there might be so much currency in the system that we can go into a hyperinflation even after he shuts the printing presses off. So back in November of 2009, I started writing an article titled, "How High Can a Dead Cat Bounce?" And I've been withholding that article until the markets peaked, because I knew that after that market crash in 2008 and the markets bottomed in 2009, that the rebound was nothing but something called a dead cat bounce. This is a stock market term that somebody coined years ago, and the theory goes even a dead cat will bounce if it's dropped from a high enough point. So when something's really overvalued, when it pops, it goes down in a crash, and then investors come in chasing yesterday's news once again, And they cause that thing, they think they're scooping up deals, and they cause that thing to bounce. And then it's still fundamentally overvalued. Our stock markets have gone back into a bubble, and then it rolls over and the crash continues. So read my article and you'll see that the markets are fundamentally overvalued, that there is absolutely no possibility that this is anything other than a dead cat bounce. If the markets go up from here and set new highs, I think it is only because it's being manipulated by the plunge protection team, and that's forcing it to go up. But whether it goes up or not, it's going to be falling in value. I believe that now is the time to get out of stocks, but this is my personal belief. I believe now is the time to get out of stock market. I believe now is the time to get into precious metals. I believe that even though we're in a short-term deflation and that cash will gain in purchasing power, precious metals will continue going up, because every time there is something wrong with national currencies, with world currencies, people rush back to real money. The currency system is developing cracks right now, and people are going to be rushing back toward real money. One thing that people don't realize is that every 30 to 40 years, the world has a new currency system. This is a normal thing. We had the classical gold standard from the 1880s until World War I. World War I breaks out, all the countries in Europe stop redemption and start printing like crazy. Under the classical gold standard, for every dollar, there was a full dollar's worth of gold in the treasury to back it up. After the classical gold standard, we had something called the gold exchange standard between the wars. And that one, the governments around the world started to cheat gold a little bit. It was a mixture of gold-backed currency and debt-based currency. Then we had the Bretton Woods system from 1944 to 1971. So an entire new world monetary system. Well, that put the world on US dollars, because every currency was backed by the US dollar. The dollar was backed by gold at $35 an ounce. August 15th of 71, Nixon closes the gold window, severing the tie between gold and the dollar, and on that day, all the world's currencies became fiat currencies backed by nothing simultaneously, because they were all pegged to gold through the US dollar. So when the tie was severed between the dollar and gold, the tie was severed between all currencies and gold. So we've been on a dollar standard. The world got flooded with dollars because of the Bretton Woods standard. Every country had to have dollars in their central bank as foreign exchange reserves. Once we ended Bretton Woods, the dollar standard started, because everybody already had dollars all over the world. So now we're on this dollar standard, but there's cracks appearing in this system too, just like all of the other systems. The reason we went on to new systems is because those systems that were manipulated, hocus-pocus systems that governments tried to come up with, they think they're smarter than the free markets, smarter than gold. And they're not. Believe it or not, Ben Bernanke is dumber than gold. The thing is, a new currency system should be coming up, and this is happening simultaneously with a market crash. The markets are fundamentally overvalued. They're back up into bubbles. The markets are going to roll over. In my article, you will see that the S&P, as a representation of U.S. stock markets, the S&P 500, is way overvalued. It's back up into bubble territory. It will roll over, and for the next few years, we're going to see a bear market in stocks continue, and you're going to see the Dow and the S&P plunging. But something I have discovered is that since the year 2000, all world markets are now trading in lockstep fashion. They all trade in the same direction simultaneously. As goes America, so goes the rest of the world. As we roll over, you're going to see the rest of the world's stock markets roll over. Now, there are major real estate bubbles going along all down coastal China, through Singapore, into Australia and New Zealand. See my video entitled The Next Dubai if you want to see how big this real estate bubble is. This is immense. As those markets roll over, you're going to see these bubbles popping, and that is happening simultaneously with this deflation. The world's central banks are going to come in to rescue us once again. They're going to try and prop this thing up, and they're going to print, and they're going to print, and they're going to print until deflation starts to give way. Then, through the miracle of fractional reserve banking, we could actually have a hyperinflation without even the governments can turn off the printing presses. We could go into a hyperinflation. So these are some of my predictions of what's coming. This may not be the final trigger. Markets could bounce. They could slap some lipstick on this pig and make it look pretty for another year or two. But you don't have a whole lot of time left. You better get in, you know. It's, for what I did for myself, I'm out of stocks completely. I own physical gold and silver that you could actually hold in your hand, coins and bars. That is what's going to be rare. That's what's going into a shortage. That is what's going to perform best. So take care, and I'll see you next time.